In this video, I'm breaking down 12 tax strategies every painting business owner should consider if you want to legally reduce your tax bill and keep more of the money your business makes. If you clicked on this video, you're probably wondering the answer to these 3 questions. Number 1, am I paying more in taxes than I actually need to? Number 2, which tax strategies actually apply to a painting business like mine? And number 3, what should I be doing before the end of the year so I'm not scrambling at tax time? My name is Daniel Honan. I'm a CPA and former painting business owner. I've worked with over 500 painting businesses from startup to 25 million over the last 10 years. And don't worry, I'm not going to bury you in the tax code or CPA jargon. I'm going to walk you through 12 strategies one by one, explain how they work in plain English, who should consider them, and some of the mistakes you need to avoid. And we're going to start with one of the most important tax decisions a painting business owner can make. Strategy number 1 is choosing the right entity. So strategy number 1 is making sure your business is actually taxed the right way. When you first start a painting business, keeping things simple usually makes sense. You might have an LLC and report the income directly on your personal tax return. But as a painting business becomes consistently profitable, that same structure may start costing you unnecessary self-employment tax. And that's where an S corporation can potentially make sense. And with an S corporation, instead of all of your business profit potentially being subject to self-employment tax, you generally pay yourself a reasonable salary through payroll and can take additional profit as distributions. Those distributions generally aren't subject to payroll taxes. But here's the mistake I see people make. They hear S Corp saves taxes and they immediately elect S Corp status. But that's not always the right answer. You now have payroll, additional tax filings, bookkeeping requirements, and the rules you have to follow. So the question isn't, should every painting business be an S Corp? The question is, has my painting business reached the point where the tax savings justify the additional complexity? Usually that's around $70,000 in bottom line net profit. And if you're an S Corp, don't play games with your salary. You need to be able to defend what you're paying yourself as reasonable compensation. All right, strategy number 2. This is about estimated taxes. And technically, this strategy may not reduce the actual amount of tax you owe, but it can prevent penalties and, more importantly, keep taxes from absolutely crushing your cash flow. A painting business can have a great year. The bank account looks good, the owner starts spending the cash, and then tax time rolls around and suddenly they realize a chunk of that money was never really theirs. It belongs to the IRS or the state. Instead of treating taxes like a giant surprise once a year, turn them into a system. You can generally approach estimates using a safe harbor method based on prior year's taxes or use projections based on what the business is actually earning this year. For a growing painting business, I like reviewing this quarterly. Look at your profit, look at how much you've already paid, look at your withholding, then adjust if needed. And the goal is simple. You want to ensure that you're not paying any penalties and there's no massive tax bill at the end of the year. Strategy number 3, use an accountable plan. So number 3 is one of my favorites because a lot of painting business owners are already spending this money. They're just not handling it correctly and getting the credit. An accountable plan allows your business to reimburse you for legitimate business expenses that you personally paid for. So think about things like mileage, your home office, your business use of your cell phone and internet, tools, supplies, softwares, or legitimate business travel you paid for personally. Instead of you personally eating those expenses, the business can reimburse you. The business gets the deduction. And when it's done correctly, the reimbursement to you generally isn't taxable income. But there's an important phrase there. When it's done correctly. You need an actual accountable plan. And you need a documentation, receipts, mileage logs, business purpose. And ideally, you're submitting these reimbursements consistently throughout the year instead of trying to reconstruct everything 12 months later. And so the idea is simple. You're already spending the money. Make sure you're getting the tax treatment you're entitled to. So strategy number 4, self-employment health insurance. This isn't a flashy strategy, but it's an area where business owners can miss deductions simply because the insurance is paid or reported incorrectly. If you're self-employed, health insurance premiums may qualify for the self-employed health insurance deduction. But how you handle it depends on how your business is taxed. And this becomes particularly important for S Corp owners. If you own more than 2% of an S corporation, your health insurance generally needs to be handled through the corporation and properly reported on your W-2 in order for you to preserve that deduction. So if you own a painting company and you're paying your family's health insurance personally every month, don't just assume your tax preparer is magically going to fix everything at your end. Make sure the payment and the payroll process is actually set up correctly. Strategy number 5 is a health savings account, or HSA. If you're eligible for one, an HSA has an extremely attractive combination of tax benefits. You can potentially get a tax benefit when the money goes in, the money can grow tax-free, and then withdrawals for qualified medical expenses can be tax-free. And that's why you'll often hear an HSA described as having a triple tax advantage. But you have to actually qualify. Generally, that means being covered by an HSA eligible high deductible healthcare plan and not having certain other disqualifying health coverage. Where business owners sometimes miss the opportunity is treating the HSA like nothing more than a checking account for doctor visits. If your cash flow allows it, you can consider paying the current medical costs out of pocket, keeping your receipts, and allowing that HSA money to remain invested for the long term. So before opening one, confirm if you're eligible, but if you are, it deserves a spot in your overall tax and retirement planning. Strategy 6, accelerated depreciation. So number 6 is accelerated depreciation. This includes things like Section 179, bonus depreciation, equipment purchases, and vehicles. And here's the most important thing I want painting business owners to remember. Do not buy something you don't need just because someone told you it's a tax write-off. Spending $1 to save a fraction of $1 in taxes is still spending $1. But if you already need another truck, a piece of equipment, or other legitimate business asset, then we want to look at how and when you deduct that purchase. Sometimes accelerating depreciation into a high profit year makes sense. Other times, it can make more sense to preserve those deductions for future use. Vehicles deserve special attention because you may need to compare using mileage versus actual expenses and depreciation. You also need to think about business use percentage and what happens when you eventually sell the asset. My rule here is cash flow first, taxes second. Make the purchase because it makes sense for the business. Then optimize the tax treatment afterwards. Quick pause. If you get value from this type of information, grab a free copy of my book, Profitable Painter. It goes deeper into the numbers and strategies for painting business owners so they can develop a more profitable business. Click the link below in the description to get a free copy of the book. Just cover the shipping. Now let's get into strategy number 7. Strategy 7 is Board of Advisors and the Augusta Rule. So number 7 is probably one of the strategies people find the most interesting. And that's using a legitimate board of advisors combined, where appropriate, with what's commonly referred to as the Augusta Rule. A lot of painting business owners already have people that regularly talk to them about their business. Maybe it's a mentor, another business owner, a family member, an industry peer, or neighborhood friends and family. Instead of those conversations always being informal, you can potentially formalize a real board of advisors, have actual meetings, and discuss financial performance, hiring, pricing, margins, growth, operations, and document what happened and get deductions for that. Now, here's the Augusta Rule. Under this rule, a business may be able to rent your personal residence for legitimate business meetings for up to 14 days during the year. The business gets a deduction for the legitimate rental, and then the rental income to you is tax-free because it's rented for less than 14 days. But this is an area where you can't just make numbers up. You need a legitimate business meeting, a reasonable fair market rental rate, an agreement, minutes, proof of payment, documentation. This is not, my CPA said I can pay myself thousands of dollars for sitting at my kitchen table. The business purpose has to be real. But this is great because a lot of folks, they'll have Thanksgiving, 4th of July, and they invite friends and family over and they'll actually discuss their business, but they don't actually get the credit, the deductions there. So think of it that way. You're not actually adding meetings to your life. You already have these meetings with friends and family. You probably talk about business. Now we're just formalizing those meetings over maybe those holidays, like think Thanksgiving, Christmas, 4th of July, And then we're just formalizing those relationships, documenting it, and then getting those deductions. Strategy 8, don't miss your spouse's employer match. Number 8 might have absolutely nothing to do with your painting business. And that's exactly why owners overlook it. Look at your spouse's retirement plan. If your spouse has a W-2 job and their employer offers a retirement plan match, make sure you're capturing the full match before looking for more complicated strategies. Because tax planning shouldn't only look at the painting company, it should look at the entire household. So find out, does your spouse have a 401k or a similar plan? And what's the employer's match? Are they contributing enough to receive all of it? So before we get creative, take advantage of benefits that are already sitting right in front of you. Strategy 9. Roth versus traditional retirement accounts. Number 9 is deciding when you want to pay the tax. That's essentially the decision between Roth versus traditional retirement contributions. With a traditional retirement account, you may receive a tax deduction today and generally pay taxes when the money comes later. With Roth money, you're generally paying the tax today in exchange for qualified tax-free withdrawals in the future. And there isn't one answer that's right for everybody. The real question is, are you better off paying tax at your rate today or potentially paying it at your rate in the future? If you're currently in a very high tax bracket and expect your tax rate to be lower later, a current deduction might be attractive. If your tax rate is relatively low today and you have decades for that money to grow, Roth treatment might be attractive. There's also another advantage, tax diversification. Having some money that will be taxable later and some money that may come out tax-free gives you those options. Strategy number 10, set up the right retirement plan through your business. Number 10 is where retirement planning can be a much larger tax strategy. Your painting company itself may be able to sponsor a retirement plan. Depending on the size of the business and your employees, that might mean setting up a SEP IRA, a solar 401k, a simple IRA, or a full 401k. The mistake is picking a plan just because somebody told you it's the best retirement plan. There's no best plan without knowing the business. If it's just you or you and your spouse, one option may make sense. Once you have employees, the economics can change dramatically. You have to think about employee eligibility, required contributions, administration, cash flow, and how much you can actually want to put away. For a profitable owner, though, the right retirement plan can potentially move a significant amount of money from taxable income to long-term wealth. So as your painting business grows, review the retirement plan along with it. Don't assume the plan that made sense 3 years ago still makes sense today. Strategy 11, look at PTET election. Number 11 gets a little more technical. It's called the Pass-Through Entity Tax Election, or PTET. Depending on your state and your entity, your S corporation or partnership may be able to pay certain state income taxes at the business level. That can potentially allow the business to receive a federal deduction for state taxes that may otherwise be limited on your personal tax return. This is not available everywhere. The rules, deadlines, and potential benefits depend on the state. So this isn't something where you watch a YouTube video and blindly make the election. Your CPA needs to model it. But if you own a profitable pass-through business, it is something you should absolutely take a look at. The question is simple. Does my state have a PTET election, and would making that election save me money? Strategy 12, hire your family members. Strategy number 12 is about hiring family members. This strategy gets abused, which is exactly why you need to do it correctly. The concept is not, hey, put your kids on payroll so you can save taxes. The concept is, if your family members are legitimately working in the business, you may be able to pay them reasonable compensation for legitimate work. For a painting company, that could potentially include things like office cleaning, organizing the shop, scanning and filing, taking pictures or videos, helping you with social media, or appropriate administrative work. But the work has to be real. The compensation has to be reasonable. So you'll need job descriptions, timesheets, proof that the work was actually performed, and proper payroll records. There are also more advanced structures that may affect payroll taxes when employing those children, but those need to be structured carefully with your tax professional. My rule here is very simple. If you wouldn't be comfortable explaining the arrangement to an IRS auditor, don't do it. Documentation is what separates legitimate tax planning from something that just looks like you made it up for tax time. So quick summary. Those are the 12 tax strategies every painting business owner should consider, but here's what I want you to do. Don't finish this video and try to implement all 12 strategies tomorrow. Your situation is going to be different from the painting business owner watching this video right now after you. Instead, go through these 12 strategies and ask yourself 3 questions. 1, am I eligible? Have I implemented it? And if I have implemented it, is it actually optimized and documented correctly? Then identify 2 or 3 of the biggest opportunities in your business and start there. Because good tax planning isn't about hunting for some secret deduction. It's about putting the right structure and systems in place before tax time. And if you enjoyed this video, watch this video on the screen now on how the wealthiest painters use the trifecta strategy to save big in tax.